I have some doubts in module quiz as well.
Okay. Which one you said? 50? Which LOS?
55 point C.
55 point.
C. Page number 85.
Okay, 55 point C. Okay. Okay, before that, I'll just see whatever I didn't do last time, okay? So that I go in the order. So this one is done, right? This one?
Computing spot
You
discount
people
forward. Yeah.
practice this one. This is
Yeah.
done, right?
Yes, sir.
Yeah.
If you have
Yeah.
not
Yes.
done anything, you let me know. This one, have you tried?
Yeah. So this one, so what we are done, right? Let's go.
I told you to, do it as the homework. Did you do?
Yeah, like yeah, I did. Like this is similar, right? This is nothing new,
Yeah,
no?
yeah, yeah. No,
Yeah.
nothing new. You did this, Shravani?
Yeah.
Yes, sir.
Okay, so this is fine. Then good. Okay. Then forward rate from spot rate. This one?
So I think we did this in class, right? Yesterday.
Yeah. So like the way they've presented it is just
Not in class,
a bit
but again,
confusing.
similar sums all we have done before.
Yeah. So
Like how to calculate forward from spot. Like this one. This is so this is 1 year, 2 year. So from
Yeah.
this 2 year, you discount
Yeah.
1 year. Like 1y is equal to that way.
So can you scroll up like in the PDF? Yeah. What is this one? Similarly, we can the next page. Yeah. This one. No.
Hmm.
Yeah. Similarly, we can back other forward rates out of the yeah. So,
We know that S1.
like, is that how the formula is derived? That's what they have done, right?
Yeah, yeah,
Okay.
yeah. Hmm. Yeah. That is, that should be some example. Okay, we'll do this, then that should be fine. See, here, try this one now. 1 year forward rate, 1 year spot rate is 5%. Or you just try first on your own, then I'll tell you. Here is the question. 1 year spot rate is 5%, 2 year spot rate is 6%, 3 year is 7%, and 4 year is 8%. We want to calculate 2y, 2y. So 2y, 2y, how do we calculate? See. First, you just try. Whatever you can, you just try. Then I will do it, okay? Try for a minute, yeah.
So here we have to calculate for 2 years, right?
Yeah.
It's 2 year forward rate, 2 year from now, right?
Yeah. Shall I do now?
Yes, sir.
See, 1 year spot rate is
10
5
point
percentage.
37.
10.04. Correct. Good. See, 1 year spot rate. Then 2 year spot rate is 6 percentage. Then 3 year spot rate 7 percentage. And then 4 year spot rate 8 percentage. So what we need to calculate is 2y 2y. So 2y 2y means this one. So how to get this one? We can take this entire 4 and remove this 2. Okay, ignore the third one, third line. This one you ignore. So how will I do now? 1 plus 8 percentage raised to 4 divided by 1 plus 6 percentage raised to 2. Okay, so yeah, now you will get for 2 years, but you want it per annum basis. Rates are always quoted per annum, so we will do 1 by 2 and then minus 1. Okay, which gives you 10.04 percentage. Is it okay?
Yes,
Yes,
sir.
sir.
Forward. Okay, now how to value your bond using forward rates? Okay, so how to value a bond using forward rates? So current spot year. See, initial year is always spot on. Okay, so don't get confused. Like, okay, here they mentioned forward rates and here they have mentioned spot rate. Initial 0 to 1 year is always spot only. Okay, then 1 year forward rate for lending from time 1 to time 2. So that means for 1 to 2, 1 to 2 it is 5 percentage. That means 1y 1y. Okay, then 1 year forward rate for lending from time 2 to time 3. That means 2y 1y. So 2y 1y, that is 6 percentage. And then 3y 1y. Okay, 3y 1y is not there. Okay, this much only. Okay. So now how do I value? So what is the coupon? 4%. No, coupon is 5 percentage coupon and 3 year bond. Okay, par value 1000. So 5 percentage, na? So 50, 50 and 50 and 1000. This is the cash flow divided by 1 plus forward rate. This is 4 percentage, first one. Okay, Second one, you see, this is only for this year, 5%. So if I say 1 plus 5%, then it is only from 0, not 0, this will be 0, this is 1, this is 2, and 3. So, it has to come from, 2 years we have to discount for. I cannot say raise to 2 now. Why? Because this 5% is only for 1 year. So if I discount, it will come only till year 1. Then what to do? From year 1 to 0. Year 1 to 0, it is actually 4%. So what will I do? When I will discount, it will come to this much, and again I have to discount. So I'll do that here itself. This is how we should discount using forward rates. So instead of doing raise to 2 for 5, I will do first year discounting and second year discounting. Have you understood this one?
Yes,
Yes.
sir.
Okay. Similarly, for the third year, this is first year discounting, second year discounting, third year discounting. Okay. Now, how to calculate this one? Again, little bit again, uh, tricky thing. As in, you calculate the first one now. Calculate and tell me the value.
It's 48.0769.
Okay. And this one, either you calculate this you can say 1.04 into 1.05, and then inverse into 50. You can do like this. Okay. Or you have already calculated this much. Okay. So what you can do is directly
Divided by 1.50, is it?
yeah 1.05. So
Okay.
do recall 1
Yeah, and then divided.
divided by 1.05.
Yeah,
So but then
45 point. Yeah, sorry.
yeah 45 point.
787.
7.
Yeah, but then it will help you only in the second one. Third one, you cannot use shortcut because 1000 is there, extra amount. So you have to do manually. So you have to take 1.04 into 1.05 into 1.06, multiply all, and then whatever you get, inverse it into 1050.
907.1117.
Is it okay? Now you add all this.
1000.9762.
1000.97.
9762. 98.
Yeah, so okay, understood this one. This is using forward rates. Is it okay? Fine.
So like why are they writing in this way the question, like the thing, uh the lending rate for lending from time equals to 1 to time equals to 2 is 1 by 1 by. What is this time equals 1
That means from time 1 to time
to
2,
time 2? Okay.
which is also known as 1y after 1 year for 1 year.
So that is for the second year, right?
That is for the only for the second year.
Only for the second year.
Spot rate means from 0 to 2 years. Spot is. This is not spot rate. This is forward rate.
Forward. Got it.
Is it okay? Is it okay?
Yes.
Yes, sir.
Then spot rate yield curve means, so this is spot rate, maturity. 1 year, let's say 3%. 1 year 3%. 2 years, let's say 4%. 3 year spot rate is, let's say, 6%. This is spot rate yield curve. Okay, which is also called as zero curve or strip curve. These are all different names. So in fact, if I say there is a zero coupon bond, imagine 3-year zero coupon bond. So zero coupon bond, 3-year, and so it is zero coupon. So coupon is zero. IY, so imagine we want to calculate IY. So face value is 1000. Present value is 970. Can you calculate the IY here?
It's 1.0204.
Hmm?
Just
No,
made a mistake. I think. Minus 3. Yes.
Shravani, you have not done. This is
Yes,
it.
do it.
So I'm again getting 1.0204.
No. I think you do second clear work, clear TVM,
Okay, I'll do it again.
second clear TVM.
Yeah,
Payment you are keeping a zero only, no?
yeah. Payment 0, 1000 is FV, 970 negative PV, N is 3, and then compute IY. Yeah, 1.02.
I'm getting 53.1.
Okay. Wait. Uh, yeah. N is 3. Present value is 970 minus. Acha, okay. You have changed this beginning mode. It is not in beginning mode, right?
Oh, I don't remember the. Yeah.
Okay. No. It is an ending only. Wait. Payment is 0.
FV is 1000.
Compute IY
Yeah, 1.02.
1.02 percentage. 970.
So what is beginning?
Huh? Beginning that now it is not required for you then.
Or by
I'll tell
default,
you it
it's
will
on
come in
ending, right?
quantitative methods. Quantitative methods it will come. Now it is not required.
Okay.
Uh,
So by default, it's always on ending only, right?
yeah, 1.02 percentage only. Okay, just calculate like this. Now tell me what do you get?
One point.
Uh, 1 plus, no, wait. 970 into 1 plus 1.02 percentage raised to 3.
Triple 9.98. Yeah, 1,000. Right?
Okay. Yeah, right. 1.02. Triple nine, that means 1000. Okay. So what does this mean? Each year, see, it is a zero coupon bond. You invested 970. You are going to get 1000. So practically, see, you are not going to get any cash, but your investment is growing at what rate per year? 1.02 percentage. And that 1.02 percentage is also called as the spot rate for a zero coupon bond. Okay, because your investment is growing at the rate of 1.02 per annum rate. What is spot rate? Spot rate means from now till whatever time period per annum at what rate it is growing, or what is the interest rate that you are getting. You are getting 1.02. So this is what actually spot rate. This is okay.
Yes, sir.
Okay. So this question can come. Yield on a zero coupon bond is also called as spot rate. Note down this statement.
Yield on a zero coupon bond is called spot rate.
Yeah, yeah,
Is a spot rate.
yeah. So in this bond, what is the yield? 1.02. That is spot rate. Okay. So that's what they have mentioned in all this. When spot rates, so can you understand this line? This entire paragraph. Still here you read. Till here.
So the downward would be from right to left, right? The downward curve, sorry, the line, right?
Uh, Downward will be from
The
right.
downward sloping would be from like
This is upward
right to left.
sloping, and
Yeah,
this is downward
cross.
sloping.
Okay.
Rates or yield. Hmm. Are you able to understand these lines till here? This blue and green color.
Yes, sir. So I think we've done this in derivatives as well, normal and inverted
Huh.
yield curve.
Okay. Yeah, yeah, yeah. Then yield curve on coupon bond is not needed. Actively traded coupon bonds at various maturities. It just shows, or you can just simply read this one line. Shows YTM for coupon bonds. Okay, for various maturities. Fine. Then par curve means the coupon which will force the bond to be priced at par. It is which is calculated using spot curves, right? Using all spot rates. That's why it is called spot curves. Then forward yield curve shows forward rates for bonds. So all forward rates constitutes as forward yield curve. Okay. Yeah, these all are sums only. So these all are, I think, you just practice this at home. If you face any problem, you let me know. Okay. These are all good one for practicing, you know, making the foundation stronger. These are all good one only. Okay.
Okay, sir.
Yeah. The next one, reading 56, interest rate, risk and return. Okay. Interest rate, risk and return. This is very, very important one now. These 5 points you need to know. Okay. So first one, an investor who holds a fixed rate bond to maturity will earn an annualized rate of return equal to YTM of the bond when purchased. If the YTM of the bond and and hence the reinvestment rate does not change over the life of the bond. That means, imagine this is a 4-year bond, and so 4-year bond, coupon is 10 percentage, IY is equal to, let's say it is 8 percentage, face value is 1000. Calculate the present value.
$1066.24.
So you are going to pay 1066.24. What you are going to get is 10 percentage, na? So 100,
Yeah,
100,
PMT.
100, 100,000. Now assuming, if you are holding the bond till maturity for the next 4 years, who holds a fixed rate bond to maturity will earn an annualized rate of return. 1 minute, just 1 minute, okay. Okay. Hello, can you hear?
Yes,
Yes.
sir.
Okay. So 100. Now, an investor who holds a fixed rate bond to maturity will earn an annualized rate of return equal to YTM. See, right now, what is the YTM? 8 percentage. Okay, remember I did this once. That this will, I'm just doing, actually I have done this kind of sum before this one, but I'm just redoing it now. See, if you are going to hold this bond till maturity, this starting IY is going to be your YTM. is equal to the YTM when purchased if the YTM of the bond does not change. So assuming it is not going to change. If it is not going to change, and if you hold the bond till maturity, you are going to get 8%, and that is why this is called as YTM, yield to maturity. Why? Because assuming if no change happens, this 8% is going to be a YTM. Let's prove that. So first of all, you are investing 100. You are investing 1066.24. You will get 100. Then what will you do? You assuming you are reinvesting. Okay. So when you reinvest, it will be 100 into 1 plus it will be reinvested at 8% for 4 years. Calculate it.
136.0488.
136.
Yeah, 136.0488.
And this one for 2 years. You will get 100 and you will immediately reinvest. Okay. At the
100
prevailing
and
market rate.
116.64. 108, right?
Yeah.
141.
Yeah. 108. So, and then you will get 100 and 1000. So you will get this much of money. Add up all this.
This is 1,460.688. 688.
So that means I can say you invested 1066.24
Yeah.
and you reaped 1460.688. You want to calculate the CAGR, compounded annual growth rate. The formula is closing value
One
divided by opening value
raised to 1 by 4.
raised to 1 by 4, 1 by n. Here 4 years minus 1. Calculate. You will get 8%
That
on
is
that.
8.18. Something. Yeah,
8.18.
8.1871.
No, you should get exactly 8.
No, I'll check it if I've made any mistake. Just
Shravani, you are doing right.
Yes, sir.
so I'm again getting the same
Okay,
8.1.
let her do. Yeah, let her do. 8.18 is little too much.
Yes, so it's 8.18715.
Okay.
Maybe because of the time period, right? Like,
So
No. Huh?
why is it raised to 4, then raised to 2, and raised to 1?
That is the problem. That is the mistake. This is 1, 2, 3 years. Raised to 3.
yeah, 3, 2, and 1, right? And
Yeah,
then,
that
okay.
is a
So only
mistake.
we'll have to correct
Huh.
the first one only, right?
Yeah.
Yeah, so it is 125.9712.
Add up again.
Yeah. Yeah, now it's 8.400006.
Hmm.
So
What is this
8%.
total coming to?
Uh, I have to do it again. I directly divide.
But anyways, whatever number you get here, that number will come here. And this is 1 by 4 is fine. Okay.
Yeah, it is 1450.6112. 5.6112.
Hmm.
Yeah.
Okay. Okay. So this proves now the shortcut method is, now this is the long cut method that I did. The shortcut method will be what? Shortcut method is 0, 4,
CFO, no? Yeah. Using CFO.
1066.24 shortcut method. 100, 100. Okay. Shortcut method will be what, see, I'm investing. See, this is like my payment 100, 100, 100, 100. Okay. So I'm investing because if it is for 10 years, I cannot keep on calculating like this, right? So how will I do? N is 4 times I'm going to invest. How much? 100. What is the future value of that? 100. Present value is nothing. It is growing at 8%. Calculate the future value. 450. So that means
450.611.
6-1.
450.611. And
Yes.
plus I'm going to get at the end. So this is the future value of all this 400, of this 100, 100, 100. I converted into 450. And then I'm going to get 1000. So total 1450.61, which I got here 1450.61. Okay. And here it is 1066.24. Understood this one? Then Kagger.
Yes.
So what have we done here exactly? Can you just recap?
What have we exactly done here, you are asking?
Yes.
Yeah. So what we are doing here is we are proving that initially whatever be the IY, okay, if the interest rate doesn't change, this is the initial interest rate in the market. Okay. Now, because I'm paying premium here 1066, even though I'm getting coupon 10%, my IY is only 8%. Now that IY, that interest rate in the market, okay, that only if it is not changing, this interest rate will become my YTM, yield to maturity. So I have to prove that finally I'm not earning 10%, I'm earning how much? 8% only. So I have to prove this. So in order to prove, I'm doing all these calculations. So how am I doing these calculations? Here, these are my cash flows, 100, 100, 100, 100. But I'm investing all these 100, 100, 100 at the rate of 8% only because the interest rate is not changing in the market. That is the assumption. Okay. If the interest rate is not changing in the market, so I am getting how much? I am getting this 100, 100, 100 becomes 450.611. And finally, I'm getting 1000 also. So I have reinvested and I converted all these 400 rupees to 450 rupees. Okay, I converted this 100, 100, 100, 100 four times to 450 rupees. Okay, plus 1000 also I'm getting. So it becomes 1450.61.
Okay, so understood.
Okay. Ah. So first point, see how you should prepare notes is write this one and then against that you write all this. You should write this point because uh, more likely that you will not be asked this sum, you will be asked this theory, but you cannot remember all this theory because the assumption how they prefer, they like giving a question or preparing question paper is that they prefer giving such kind of statements which requires a lot of practice of sums. That means if you can understand this statement, that means you have practiced enough sums. So theory also sums also that means, because if you know the sum, there is no guarantee that you know this theory. But if you know this theory, it's more likely that you will know the sum because you cannot mug up all these things. Understood? So that's why when you read all this, you have to practice as well very well. Okay, so you have to practice so very well that you are able to understand all these things. Your mind accepts the statements. Okay, so I'll move to the next one now. An investor who sells a bond before maturity. An investor who sells a bond before maturity will earn a rate of return equal to the YTM at purchase if the YTM has not changed since purchase. An investor who sells a bond before maturity. Okay, so suppose, assume interest rate is not changing, but the bond is sold before maturity. That is the condition now.
It's the same thing, just the duration
Yeah,
has changed, right?
yes,
You're selling it earlier.
yeah. So now again 4-year bond. Four-year bond. Uh, okay, 4-year bond. Now 1066.24. 100, 100. This is the initial cash flow. But assume you are selling it at the in the third year itself. If you are selling it in the third year itself, how will you treat this? Or what will be your returns? So according to this statement, what will be your return? It is equal to the YTM. What is the YTM? 8%. So you are going to get 8% only. That's what I need to prove. You understood what I need to prove now?
Yes, sir.
Okay. So let's do first manually long cut. So you are, remember, third year, you are going to, third year ending, you will take this 100 rupees and you are going to come out of the bond. So first you will reinvest this for how many years now?
2 years.
2 years, correct. So calculate how much.
116.64.
116.64.
Okay. Then
108.
1 year.
so yeah, this is 108
10.
and this is 100. So you,
Yes.
okay, now you add up all this.
324.64.
Yeah.
324.64. Okay,
64.
now this is what, this is the future value of all coupons. Future value of
But at
coupons
the end of year 3, right?
at the end of year 3. Okay, at the end of year 3. At the end of year 3. Now I also want to know what is the present value of the bond at the end of year 3 when I will sell. So then how will I calculate? In the previous case it was not needed because I was selling at the end, and at the end it was 1000 rupees.
Like 1100
But
by 1 plus
yeah,
8%.
yeah. Now what will I do now? Now this is what I'm expecting in the bond. Remember, present value of your bond is equal to present value of all its
Future cash flows.
expected future cash flows. Future cash flows. Okay, present value of your bond is equal to present value of all its expected future cash flows. Okay, so how much, what will you expect in future? See, this is what you are expecting, its present value. What is the present value? You will discount it. Calculate.
1018.5185.
1018.5185.
5185.
Now that means when you sell, you will get 1018, and also because of coupon, you got 324. So total amount you add up
1343.1585.
1585.
Yes.
Yeah, 158. Yeah.
Yeah, and you invested 1066.24. Okay,
Yes, sir.
so what is the CAGR?
So now it will be
One
1
three.
by 3, right?
Yes,
Yeah.
yes, it is only for 3 years now.
Yes. 1.08.
That is 8%.
8%,
Yeah.
yeah.
Okay,
8%,
which is equal to what?
8.3%.
Initial YTM.
Right.
Okay, this is the proof. Now I'll do using shortcut way also. Shortcut way is 1, 2, 3, 4. So here, right? So now N, IY, present value, payment, future value. N is what? 1, 2, 3, 8. Payment is 100. What is the future value? Calculate.
Sorry, 324.64. So it's coming negative. Negative.
Huh. Uh, if you keep this, it will come as negative. Okay, because you are, when I say positive, because I have taken payment as positive. If you put
Yeah.
payment minus, then it will come as positive number.
Right.
Okay,
Right.
because you are, let's say if you are investing, so you keep this as 100 negative, you will get
Yeah.
positive number. Okay.
Like in this scenario, like it is like we are investing 100. Right.
Yeah.
Yeah.
Then present value, this one, this one you can directly do like this, the way I did 1 plus 8% raised to 1. If you don't want to do, if you want to use only this calc, then you can do like this: 1 year, 8%. What is the present value? Payment is 0, or payment is 100, you can say, and future value is 1000. Calculate present value now.
There is 1018.5185. It's the same.
101.
8.5185.
That is what we received here.
Yeah.
1018. So these two add up 101343.
Yeah. 0.1585. 1.18.
Okay, and this number here, and then you will do Kaggle. Okay, this point is okay.
So here we took like 1000 is FP.
What happened?
Like this shortcut thing, what did we do? Yeah. Uh,
100, one payment you are receiving, and future value 1000.
okay. Okay. Yeah. Got it.
Third one, you do one thing, take a minute and just go through whatever we have done. Okay, just go through whatever we have done, and then I'll continue with the third one. Just process that, all that information in your head. Just you may just read these two. Okay. I'll go with the third one now. Okay. See, if the market YTM for the bond, our assumed reinvestment rate means that 8% at which you are reinvesting, okay, increases after the bond is purchased, but before the first coupon date. An investor who holds the bond to maturity will earn your rate of return, will earn your realized return that is higher than the original YTM. So what does that mean? That means imagine it's a 10-year bond. Coupon is equal to 10%. Okay. Then IY is equal to 8%. Okay. Or I'll make it easy, 10%. So future value is 1000. Present value is also 1000. How? Because these two are same. Now, what are they saying? If the interest rate goes up, okay, then your YTM will be more than 10%. So, okay. Oh no, third one I'm doing, right? Not the fourth one, third one. If the market, okay, our assumed reinvestment rate increases after the bond is purchased, so interest rate increases by 1% before the first coupon date. Before the first coupon date. Okay. What will be the realized return? This is the question. What is the realized return if the investor is holding the bond till maturity? This is the question. Okay. So how do I calculate it now? See, it is increasing by 1% means what is the new interest rate? 11%. Now 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8. Okay, 9 and 10. Okay. So here this is present value is 100. You will get 100, 100, 100. Okay. So now just 1 minute. I'll plug in the charger to the laptop for a minute. Hello, can you hear me?
Yes, sir.
Okay. So now before here, somewhere here, the interest got changed to what? 11%. So that means all the reinvestments you are going to do at what rate now? 11%. Have you understood?
Yeah.
Okay. So now all these reinvestments, future value, let's calculate. NIY, present value, payment, future value. So N is
Like
10
soon after
times.
buying, the interest rate increased, right?
Huh?
Soon after buying, as in before
Yes,
the
yes,
first year completes.
yes, yes. IY is what?
So
IY
we'll take
is
IY as 11.
Yeah.
IY
Yeah.
is 11. Sorry, yeah. We are reinvesting at 11 percentage.
Yes, sir.
Present
PB is
value is 0.
0.
Pay is
EV
100.
is 0.
What is the future value? Check.
There is 1672.20.
167.2.20.
167.0.
2.2.
2.20. No,
2.2.
0.20.
Yeah.
Yeah.
So that means you are going to get 1672.20.
Hmm.
Then at the end, you are going to get this 1000 also. So that means its value is
2672.
2672.20.
2672.20. Yeah.
Okay, and the present value is 1000. So now you calculate the CAGR. Will be 267.2.20 divided by
10.32%.
1000
267.2.20 raised to 1 by
by 10.
10 minus 1.
Yes, so 10.33%.
10.3. Yeah,
10.3.
10.33%.
33%.
So which is more than 10 now, right?
Yeah.
Yeah.
So this is what it says. Understood this point?
Yes.
Okay. Now similarly, if the interest rate comes down, then it will come down to lower than. See, the logic is very simple. Logic is what? You are reinvesting continuously at a higher rate, 11
Yeah.
percentage. So it is going up. Similarly, if you reinvest at the lower rate, then it will come down. So let's do another one where you are reinvesting at 9 percentage. Then it will be less than 10 percentage. So let's do that one now.
So in that case, the FV will be 1519.
Wait, I'll do this. Wait. So this is 10 years, okay? And all. So now NIY N is 10 years, IY is 9 percentage, okay? Let's say it is coming down by 1 percentage. Payment is 100. What is the future value? Calculate.
1519.
1519.29.
1519.29.
0.29. We'll
And
get
finally you will get
1000.
1000.
Yeah.
So total will be 2005.
2519.29.
And here it is 1066.
9.68%.
Here it was 1000 only, right? It was a
Yes,
par
yes.
value bond.
Yeah.
Now CAGR
9.68.
9.68. 9.68 percentage.
Hmm.
1 by 10 minus 1. Is it okay?
Yes, sir.
Okay. You should practice this very well, okay? You will for sure get at least 1 or 2 questions from this, okay? Third one is over. Now, fourth one is even trickier. Fourth one is the most, it is very counterintuitive. So far, the intuition was also working. Okay, that I'm reinvesting at the lower rate, so I'm getting less rate. I was reinvesting at the higher rate, so I'm getting higher rate. So it is intuition. Now this one, fourth one is counterintuition. Okay, counterintuitive. So just go through this. You read this now. Read.
Sir, so if we sell the bond before its maturity, so in that case we will earn less.
Huh. But the interest rate has gone up. How is it possible? Is it intuition wise? Is it making sense? You see, it says interest rate has gone up,
Yeah.
but you are earning less. So it is. So that means it is counterintuitive. No? They like asking this kind of counterintuitive question.
Sir, but is it the only case where the bond is not held till maturity?
So can you explain this point?
Yeah. Is it the only case where the bond is held, not
Like
held
they
till
have given
maturity?
4 or 5 cases, right? So
Ah.
is this the only case in which bond is not held till maturity? Like
No, even
it is
second
sold
case you
before.
did not hold it till maturity, no?
Okay.
Second case also before maturity you are selling.
But in that case, interest rate was not going up.
Yeah. But so otherwise, this is the case.
This one is they're saying here it is held for a short period. Like,
See here, this is 10-year, okay?
yeah.
So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 1000. And this is all what? 100, no? 100. Okay. So now so you are going to hold this bond only for short period. Interest has gone up, okay? Let's say you are holding only for 2 years. Now let's see how it works. So NIY present value, payment, future value. So what will be N2?
Yeah.
And interest has gone up,
Up.
so 11%, let's say.
Yeah.
Okay, present
Yes.
value is 0, payment is 100. What is the future value? Calculate.
211.
211.
211. So
11.
this is 211. This is the future value of these two coupons.
Yeah.
Now, what is the present value of the bond? So I need to calculate present value of the bond.
So
So,
N will be 8.
so present value of the bond is present value of all its expected
With
future cash
expected cash
flows.
flows. Yes.
So here NIY, yes, N will be 8 only.
8.
Yeah,
I by Y is 11. And then
N will be 8. 8 years are
Yeah.
there. IY is 11. Present value we have to calculate. Payment is 100. Future value is 1000. Calculate the present value.
that is 948.53.
538.
Yeah.
538. So this amount 211 also you are going to get, and this 948.538.
So that is 1159.54.
So total is
1009.53.
1150.
0.53.
Okay. So this much money you are going to get. You invested how much? 1000.
1000.
So CAGR.
6.2.
That is
6.3.
7.68.
CAGR is what? 1159.53
53 divided by
divided by
1000.
1000.
Raised to 1 by 2.
1 by 2 minus 1.
Yeah, I got 7.68.
7.68.
7.68.
Yeah.
Yeah, so interest rate went up and
Yeah.
your return has come down.
Hmm.
So it is counterintuitive, right?
Yes, sir.
But this proves the point. Mathematically, I have proven. Conceptually, we
So
will
now if
understand.
we hold it till maturity, then what will be the return? What will be the CAGR?
Then the interest rates, the yield will go up. That's what we saw in the previous one. No?
Yes.
So is this because
Increases.
since the interest rate has increased, right? And now, like because we are holding it for a short period, that is for 2 years. So when we are discounting it, like the FV, so it is giving us a small amount. Is it because of that?
Correct, correct.
So because when we are discounting it, like it has increased by a percent, right?
Yeah,
So for
correct,
8 years.
correct.
Okay.
Yeah.
So like it
Now,
is
I did
better
not
to.
understand
correct.
what you
Yeah, yeah.
said.
No, I'll explain. Yeah, yeah. So he says because interest rate has gone up, so I'm going to discount all this amount at the higher rate,
Hmm.
11%. So the amount will become lower. That is
Yeah.
mathematically he's telling. Now I'll tell you conceptually. So mathematically, what he said is right. We are discounting at the higher
So they
rate,
are
the
getting
amount comes down.
discounted at 1% higher rate.
Yes, yes, correct. That is one reason. Now, conceptually, how to understand? See, remember I said when the interest, what is the relationship between interest rates and bond price?
Inverse.
Inverse. That means when the interest rate is going up, bond price should
It'll go down.
Go
Like,
will
down.
come down. So now when the interest see when interest rate is changing, there is there is one variable that will favor you, there is another variable that will go against you. Say for example, when the interest rate is going up here, you are reinvesting at the higher rate, which is good or bad. 100 you are going to reinvest at the higher rate. So
good
reinvestment,
for us.
yeah, see, one is called reinvestment risk, another one is called, you are taking two risk when you are investing in a bond, reinvestment risk. Another one is called price risk. I will come to the price risk. Now reinvestment risk is favoring you, right?
Yes.
It is favoring. Why? Because you are reinvesting at the higher rate.
Higher rate.
So it is good, favoring you. But then what is price risk? Price risk means what? Price risk means the relationship between interest rates and bond price. Relationship or change in the bond price because of interest rates. Price risk means change in the bond price.
Since the interest rate is going up, the bond price will come down. So the
Yeah.
it will be negative.
Yeah. Change in the
Like,
bond price because of interest rates.
so a person
Because
who
of
wants to
interest
hold it
rates.
for lesser time, he would favor like low interest, right, in the market.
See here, when the interest rate went up, uh, so when the interest rate is going up, then bond price is supposed to come down. That means the price risk is against you. The price risk is against you. Is this okay? Because the price is going to come down, bonds price. And between these two, now what do you think? This 2 year is more powerful or 8 year is more powerful? Obviously
8 year.
8 year. So that means against you is more powerful now. Price risk is more powerful.
Uh,
So price risk, that means bad news are more for you.
right.
Right. Now when bad news are more for you, then what will happen? The bond price is heavily coming down. And that is why the this closing price 1159 is highly it has come down, and so your returns has come down highly. This numerator value has come down highly, so your returns has come down highly. Have you
So like
understood?
in the short run, we face price risk, and in the long run, reinvestment risk.
Short run, in the short run, yes, short run means you are a short term investor. In the short
Yeah.
run, price risk, you are facing more price risk. Short run price risk is there. That means your bond price will determine in the short run. When you are a short term investor, bond price will determine the return. If bond price is going up, your returns are high. Bond price will determine the return. Is it okay?
Yes.
Now we will take the other way around. What if the interest rate would have gone down? Then what would have happened? Let's see. So the interest rate would have gone down. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Hmm. 2 year, the interest rate has come down to 9%. Okay. So now you are going to reinvest at what rate? 9%. So 9%. Payment 100. What is the future value? Calculate. Hello? Hello,
Yes,
can
it is
209.
9 20.
209.
209.
Uh,
209.
Yeah.
yeah,
Okay, exactly 209.
yeah,
Yes.
exactly.
Okay, now you see interest rate has come down. So ideally return should come down, but no, it will go up highly. Let's see. 209 is the future value. And now you see, because interest rate has come down, it is extremely good for the bond. So bond price will jump up highly. So bond price perspective, it is 8, 9, then present value we have to find out 100
Yeah,
and then 1000.
it is 1055.34,
Yeah,
One zero.
1055.34.
and the total
So
is one.
That's
105,
1264.34.
1055.34.
Yeah.
Huh? How much?
The
1264.34.
1264.34.
Yeah.
So that means CAGR, compounded annual growth return, is closing value 1264.34
Hmm.
divided by 1000
12.44%.
raised to
1
1
by
by
2.
2
Yeah.
minus 1. 12
12.44.
point.
12.44.
So that means in the short run, because it is a short term, like short term investor now, price risk is playing. Price risk means what? Because interest rate came down, bond price went up. So price risk is more powerful, and that risk favored me. And because that risk favored, my returns has gone up to 12.44 from 10 percentage. Is it okay?
Yes, sir.
Yes, sir.
Okay. Then this fourth one is counterintuitive. The rest is all okay only, but you can expect definitely one question from this. Okay. Fifth one. Fifth one. You just read this in the meanwhile. Yeah. If the market YTM for the bond, our assumed reinvestment it decreases after the bond is purchased, but before the first coupon date, a bond investor will earn a rate of return that is lower than the YTM at bond purchase if the bond is held for a long period. Long period, you can think like YT, held to maturity. It is as good as held to maturity. The result is as good as held to maturity. That means this is the result. Which one? This one. Held to maturity. So if the if the interest rate is going high, returns will be high. If the interest is coming down, return will be down. Same rule only. Okay. Yeah. But we will just do one so that we have the example. So 10-year bond. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10.
Sir, if it is held for longer period, then N will be greater than 10, right?
If it is held for longer
Longer.
period, n will be greater than.
10.
No, longer period means the
Okay,
maturity itself
longer.
is 10. So let's say longer period here, it means let's say 8 years.
8. Okay.
Okay, now you invested 100. Here it is intuition only. See, you are
Got it.
reinvesting for a long period. 100, 100, 100, 100, 100, 100, 100, 100. Okay, 100, 100, 1000. Okay, so this future value we will calculate. N is 8.
8.
IY is interest rate has gone up, let's say. So 11 percentage, okay? From 10, it has gone to 11. Present value is nothing. Payment is 100. What is the future value? Calculate.
1185.94.
1185.94.
94.
Okay, now present value of the bond. So that is 211. Present value we have to calculate. Payment is 100, 1000. Calculate.
982.87.
988.
982.87.
982.87. 982.87.
Okay, so this is 1185.94 and this is 982.87. This is all straight linear.
2168.81.
2168.81
Yeah.
and you invested 1000. So CAGR 2168.81
10.16%.
raised to 1 by
8.
8 minus 1,
10.16.
which is higher than 10 percentage. This is intuition. Why? Because in the long run, okay, in the long run, this is going to be more powerful, reinvesting. So in the long run, reinvestment risk is more powerful. So whatever happens with reinvestment, so reinvesting, you are reinvesting at the higher rate, so it is good for you, so it is favoring you, so your returns are going up. Fine. If I would have reduced it, see, this certainly here bond price will come down, but the impact is very less because it's only for 2 years.
Okay.
Whereas
So,
the
sir,
favor of
longer period
reinvestment is
means more than maturity, more than majority, like more than 50%.
okay. Now, what is that? What do you say? Exact threshold that we will see probably next time we will see. So don't think it is exactly 50 percentage. That we will calculate and find out.
Okay, sir.
Okay, so that we will see next time.
So, but
Okay.
it must be some rate where, like, till where
Yes.
the discounting of the remaining years is less
Yes.
than the.
Yes. Yes. There
Yeah.
is
Fine.
there is a way to calculate that threshold.
Okay, sir.
Okay, where it is neither short term nor long term. That we will
Okay.
calculate. Is it fine till here? It's okay.
Yes, sir.
Yes, sir.
Yeah. So this is what this topic is all about. Fine. I think now I can stop here. So it's a very, very important one. So please practice this very
Yes.
well. Okay.
Hmm.
Fine. We'll stop now
So,
here
do
then.
we have lecture tomorrow?
Sunday.
Yeah.
Sunday night.
So can we
Night.
skip for tomorrow, like if it's possible?
Okay. Fine. No, not a worry. Okay.
So,
Okay.
sir, can we do something like
Hmm.
any subject for which they don't need the class, like they are done with that subject, so and which is pending for me?
Yeah. Okay. So you want me to finish it up like sooner, is it?
Yeah, something which they have already finished.
Okay. Okay. Then I will call you and then talk like
Okay,
which
sir.
subject, which are the subjects pending for you now then?
Alternative investment, um, और कौन सा बचा है? Portfolio management, and I guess I
Fine.
don't
So I'll.
remember. Sorry, ethics.
Okay. Okay. So that will not take time. Okay.
Okay, sir.
Anyways, I'll call you and talk then. Okay.
Okay, sir.
No worries.
Thank you, sir.
Okay.
Bye.
Bye. Bye.
Good night.
Bye. Good night. Bye.
Thank you,
Thank
sir.
you, sir. Bye.